Good evening, everyone, and welcome to tonight's webinar, Truth or Consequences, What Every Future Dentist Should Know About Taxes. I am Chris Okowski, as does Business Development Manager, and we're glad you've joined us as we have a very informative and interactive presentation planned for you this evening. During the presentation, we encourage you to submit questions via the Q&A feature. Our presenter is eager to answer your questions and help you understand more about creating healthy financial habits now to ensure a successful future. We'd like to welcome and thank Chalwa and Associates as a sponsor of tonight's programming. I would now like to introduce our presenter, Roger Chalwa. Roger Chalwa is the owner and CEO of Chalwa and Associates, an accounting firm in Illinois, providing tax, accounting, and advisory services to individuals and businesses for over 30 years. His experience spans professional service industries, including technology, healthcare, real estate, and nonprofit organizations. His healthcare expertise includes financial reporting for medical and dental practices, coordination with external consultants, and advising on cost control and valuation matters. Roger also assists clients with complex tax planning strategies involving international reporting, business deductions, education credits, and retirement planning. A trusted advisor to small and medium-sized businesses, Roger is a member of the Illinois CPA Society, the AICPA, and several national tax associations. He has presented joint seminars with the IRS, law firms, banks, and professional groups on topics such as business startups, payroll tax compliance, and evolving tax legislation. Please welcome Roger Chalwa.
Thank you, Chris, for that introduction. Um, I'm Roger Chabla. Sort of glad to be here, presenting hopefully some worthwhile information that you guys can take in tonight. This is just a little snippet of things that you guys need to keep in mind as through your journey. So glad to be here, and we'll get started. Okay, you guys are going to be in various stages, whether anywhere from first year to fourth year students, and a lot of this pertains obviously to the third and fourth year, but it's good to keep in mind your long-term objectives and where you want to be. And even if you're not thinking about that, each and every one of you does need to file a tax return, and it's just basic financial tax knowledge. We will obviously discuss a little bit uh, of the big beautiful tax bill that just came out a couple of months ago, actually January 4th, and now we just got through the tax season, and a lot of that is being interpreted. But for this session, we're gonna focus on some of the common themes that you, as um, graduating seniors or looking forward to that, these are some decisions that you're going to be faced with, and we're here to at least get you thinking about those issues, and hopefully tonight's seminar will provide some more information. So some of those key elements are, hey, whether I'm going to be an employee or an independent contractor. Um, One is, as you guys, W-2 employee, that's you may want to work for like a big practice where everything is set for you versus the choices that you may have as an independent contractor. And that really implies a little bit more discipline and also opens up the window for some additional deductions. And we'll go through that in tonight's presentation. Also recognize that if you do go through the concept or the umbrella of being an independent contractor, what are possible deductions, and the concept of reasonable, ordinary, and necessary businesses that deductions is key to being self-employed. You may have heard the term 1099. um, in various types of situations, but that really means that you're an independent contractor. Uh, Key steps, considerations, and pitfalls when potentially establishing a new dental practice or even going into business for yourself. And then we'll also highlight um, some adjacent areas not exactly related to being in your own business, but a little bit about student loan interest and the thresholds for deducting student loan interest. I know that's probably high topic for you guys because um, you're lucky if you don't have any debt, but I'm assuming a lot of you do, and so we'll touch base on that. Um, so moving on, we do have a poll question at this time, just so it'll help me establish or help me kind of set the path on which just whether you're thinking about starting a business or maybe one of your friends or parents or a friend already has a dental practice or a group that you're already familiar with, or you want to work for a big group like an established dental practice, or you want to go corporate, or you're still undecided. It'll help me kind of structure tonight's presentation. All right. So I'm looking at the results already, and and 32% of you are still undecided, so you'll get a lot of basic information. 16% of you will be working for big dental groups. 29%, almost 30%, um, will be working for an established dental practice. So tonight's seminar will be very relevant. And then the top one is actually 23%, and you're starting or thinking about buying a dental practice. So combined, 23 and 29 is a big percentage. And uh, and so that takes us almost to 30, 54, 52. So that's more than half of you that are thinking about um, going into business for yourself, i.e., opening up a dental practice. And so that's kind of like half of you. Plus, if I drop in the 32%, another 16%, that's over like, you know, 68%, something like that. So I think tonight's topics will be very relevant for you guys. So thank you for answering the poll question.
Click the screen. Yep, just right anywhere.
Okay.
Yep, now though.
All right. Some of the basic differences, employee versus contractor. Um, so when anybody refers to you guys as a 1099, that means an independent contractor. So that means you are both the employer and the employee. And as such, even though you may be working for one location, you're really given the rights and obligations of having your own business. Now, you may have that structured under what we call a sole proprietor, or you can open up a corporation, whether it be a regular corporation, also known as a C Corp, or also a small business corporation, also known as a S Corp. And if you're going to go into partnership with another dentist, then that would be a partnership. But those are all leaning a little bit more towards the 1099 contract model versus the employee model. Choosing which one really is not only tax based decisions that need to be made, but also you have to know your own personality, and we'll get into that to decide, hey, whether you like a very structured environment, or are you actually very disciplined about following certain paths and procedures, um, and defining kind of setting those rules on your tax journey. Okay, how each status affects your paycheck and taxes. We'll take a deeper dive onto that. Pros and cons of each. I just delve into that a little bit. Also depends on your personality, your strengths and weaknesses. Forms, W-2s versus 1099. A W-2 is something that you would get while you're working for a big corporation, and then common red flags and misclassification risks, and we're going to get a little bit more into that as well. All right, so as a W-2 with an employer, your taxes are withheld automatically. Now, which taxes am I talking about? The main ones would be federal income tax and state income tax. And so there, you know, there are seven actually phases. We're in what we call a progressive tax system. So anywhere from 0 to 37%, and depends on your income level. And so your employer is automatically going to withhold that based on when you fill out something called a W-4. And that's something you usually fill out the first day of work or even prior to that, letting the employer know how many dependents you may have, and though the amount of federal income tax and state income tax is determined by how many dependents you may have, and that will impact the federal and the state income tax withheld. So those are two categories. The other one would be something called Social Security and Medicare. So when you are an employee, the employer would deduct half from your paycheck, and then they would match half. So it's a 50-50 relationship of the Social Security and Medicare. This is in contrast to if you're an independent contractor, you have to, since you're the employer and the employee, you would have to pay the full 15.3%. So where am I getting the 15.3%? That's made up of Social Security and Medicare. So Social Security is 6.2%. And if the employer matches it, 6.2 plus 6.2 is 12.4%. And then the remainder is 1.85%. And then the matching would be 8.5%. I'm sorry, it's 1.45%. Times 2 would be the 2.9%. So if you add the 12.4 plus the 2.9, you're going to get the 15.3%. And I think if we will send out a more deeper dive, we have like a 20-point checklist breaking these taxes down so you fully understand that. And then I think the organizers of this presentation are going to send that to you as a follow-up as well. So that covers 4 taxes. We got federal income tax, we got state income tax, and now we're talking about Social Security taxes and Medicare taxes. The next type of tax is something called unemployment and workman's comp. So unemployment, as a W-2 person, you actually do not have to pay any of that. You are covered under your employer's workman's unemployment policy, and so your employer would pay 100% of that. Also, that would be workman's comp. So those are 2 different types of taxes. Workman's comp is not necessarily required in every state, but it's good to have if you're going to have employees. And so when you're self-employed, you would have to cover these taxes as well. They're not onerous, but they are a few $100s. And like I said, so under the 1099, you would have to pay your own unemployment and workman's comp. So like we said, based on the W-4, depending on how you get paid and the frequency of when you get paid, your taxes are withheld automatically. Again, depending on your W-4 and the Illinois W-4, if you work in Illinois. 1099, assuming you're going to have a profit. So you have gross income or total income minus your expenses, and then whatever that bottom line is, the net profit, that's what you got to pay self-employment taxes on, and also federal income taxes. All right, benefits and deductions. Again, if you would like to work in a very, very structured environment and you have so many things going on, W-2 may be the best way to go. As we're going to see in upcoming slides, um, the deductions are kind of limited, and that's what this is pointing to. In the 1099, i.e. sole proprietor, self-employment arena, even though you have to kind of fund your own taxes, you do get the benefit of a fairly, um, deductions, even though you may be a one-person show, you would have the same umbrella as businesses that are much bigger. Again, we have a 20-point checklist that we can go over, maybe even in the Q&A. So, all right, so to bring it home, we're going to go through two scenarios, and these are actually two examples taken from two different dental clients that we worked on last year. And so it's just a compare and contrast, just so you can see how these things break down and you can visualize where the numbers lie. So the assumptions we're making, Illinois has 4.95% state income tax rate, so we're assuming 5% state income tax, filing as a single person, and then taking the standard deduction. Same amount of income. These two individuals both are going to make 100,000 per year. Under the independent contractor scenario, we're going to have $20,000 as deductible and reasonable business expenses, and they can also contribute a little bit to their pension plan, in this case, self-employment individual retirement account. All right. Just to go through some of these details, W-2 employee, again, from the polling questions, that's 30 to 40%. And the independent contractor, which are going to be 50 to 60%, based on the polling question. So gross income is 100,000 in each scenario. Here we get business expenses. Under the W-2 scenario, there really aren't any business expenses that you can take. The new bill, not to complicate this discussion, but the new bill does allow for a personal auto deduction given certain parameters. We can discuss that in the Q&A, and that's in the latest tax bill. But assuming 2024 rules to a point 2025 rules, you're going to see that the net business income here is 80,000. Going back to the 7.65, we talked about that. That's a Social Security and Medicare. The employer would fund half of this, and you as the employee would fund the other half. That's how we got the 7650, which is half of 15.3. And here, you as the owner operator would fund the entire 15.3%. So, so that would be the self-employment tax. Deduction for half of self-employment tax. The IRS gives you a deduction for half the amount right here of $12,240, so that's a $6,120 deduction. You get an additional, again, this is an assumption that you're going to put 10% in a pension plan, which is fully deductible. Under the employer, you may have a wait clause. Usually it's 1,000 hours, or it could be whatever the rules are for being involved in their pension plan. Usually it's a 1 to 2 year wait. If you also want to heading towards a partner comp plan, that may be a 3 year wait. But here you're kind of vested from day one if you have your own business. Then the IRS has this concept called adjusted gross income. And so here it would be 100,000 in the W-2 employee scenario. And under the independent contractor scenario, you would get the 80, which is 100 minus the 20, minus the self-employment, and then the pension deduction. The IRS also gives you, under the TCJA, which is the Tax Cuts and Jobs Act, and now the new bill made that deduction permanent, a 20% deduction, also called a qualified businesses deduction, because you're considered a small business. And I think if you make less than, I think it's 25 or $30 million, which is a big amount, you would get the small business qualified business deduction, which is 20% of your AGI. So that is an additional deduction that you would get if you're self-employed. Since this example gives a single person, the standard deduction would be the same. The taxable income on the amount that you're paying taxes for would be 85,400 under the W-2 example and 33,280 on the taxable income. And so based on federal income taxes, this is roughly 10%. And then under the W-2, your tax bracket would be a lot higher. Now, the 3,400 is just federal income tax. That does not include the self-employment tax, which we are going down to the bottom line, near the bottom line. It's one up. So we got the state income tax, the federal income tax, and here we add half the amount of the employee, which is a 7.65%, the self-employment tax. And here the individual had to fund 100% of their self-employment tax. So if you take into account the net take home after the aggregate of all the taxes, the net income that you're going to take home is it's about $8,000 higher in the self-employment scenario. So most people would opt for being self-employed because, again, you get the $20,000 deduction. But the taxes that have to be paid, the 17,304 versus a 25, the 25 is kind of like you're an employee, your employer withholds the taxes, and it's an easier scenario. However, if you want to basically get the benefit of the business deductions and pay less taxes, then the self-employment scenario may be better, but it does involve a little bit of discipline and rigor and just getting into that cadence methodology of paying taxes every quarter versus every paycheck. So, a lot of people want to be under the independent contractor, but we find in our situations that some people spend that money, they're not as disciplined in the beginning, and then the IRS, even though their funding may be cut, they are actually very diligent about penalizing people on failure to file, failure to pay estimated taxes, and those sort of things. So it really depends on your personality. Okay. Moving on. So we wanted to also get into the type of deductions that you can take if you decide to be an independent contractor. Some general rules are you can take ordinary and necessary deductions. Now, what does that mean? That means those are expenses that are common and normally accepted in your trade or business. And they should be reasonable in amount. So dentists would be classified under a certain, what they call a SIC code, standard industry classification code. And so it's basically the IRS has statistics on thousands and thousands of dental firms out there, and they have developed a mean, a median for those types of expenses. So that is what, if you decide to go that route, that's going to be, that's who you're going to be compared against. And if you are, let's just say, you know, within 10 or 20% of those median numbers, then you're going to be okay. But if you are going to be 80% away or two standard deviations away from the common, the average, then those might be red flags. So we'll go through some of those things for dentists. Obviously, common expenses would include supplies, uniforms, insurance. Um, we're going to get into home office and vehicle basics, which each and every one are you going to have, record keeping, and then avoiding some gray areas that are, I would say, red flags, traditional red flags.
Roger, we
Yes.
have a question if you'd like to answer it.
Yeah, no problem.
Okay, great. So one of our attendees asked, is there an option to defer quarterly income taxes and have them paid at the end of the fiscal year during tax filing?
And so I'm assuming this is under the independent contractor scenario. Yeah, so assuming that, so the IRS believes in something called the pay-as-you-go system. And so let's say you get paid every 2 weeks or even every month at the latest. And so when you are getting a paycheck, your employer is actually paying the related federal income taxes, state income taxes, your self-employment taxes every paycheck. And so they don't want to give you an advantage of delaying paying those taxes simply because you're self-employed. So, so what they're going to do, let's say in that previous scenario, your income is $80,000. Okay. Um, and so they're going to divide that 80,000 into four. So that would be 20,000. And then you would be expected to pay the related income taxes, self-employment taxes every quarter instead of in that last quarter. So that's what they're going to assume that that 80,000 is earned what we would call ratably over the 4 quarters. Um, if you did not earn that 80,000 evenly, then there are additional tax forms that you can fill out so you don't get unnecessarily penalized. So in that scenario, if you would have gotten paid whatever, 10,000, 10,000, 10,000, and now you got paid 50,000, in the fourth quarter, you would actually have to fill out specific forms so you don't get burdened with paying those taxes late. And that actually has to reflect, obviously what happened and and um and so in case of an audit, not that that would occur, they would actually like to see that they could ask for those records to make sure you got the majority of your income in that last quarter. So I think it's a fact and circumstance type of question. I hope that helps. Any other questions, Chris, that you may have? Since
That's the only one that's come up now, but if anyone else would like to drop some questions in the Q&A, please do.
All right. Well, very good. All right. So one of the first things one of our clients did was buy this baby blue M3. So that's uh, and he was a recent grad, dentist now, and then he went the independent contractor route, and and then we helped ease the cost of owning the vehicle. That was the vehicle that he always wanted. So basically, there are two methods. Again, this is assuming that you are self-employed. So there's the standard mileage method. And so the IRS has come up with the cost of maintaining a vehicle, and this gets indexed every year. And the latest, I believe, it was 65 cents a mile. Now it may be 68 cents. It changes every year, but let's assume it's 68 cents a mile. So what you would have to do is you would have to take the total miles driven, and then you break that down into the business miles that are driven, which means the mileage from your home to the practice, and anything that would be business related. So you would get a percentage. And then you still have to maintain a log on what the business percentage is. And so whether you're using the actual method or you're using the standard method, the business mileage needs to be tracked. I think there are apps for that right now, which a lot of people are using just to, make tracking that. It doesn't have to be something fancy. It could just be a manual log or an Excel spreadsheet, and which will help determine what is business and what is personal. Personal miles would not be deductible. So the standard mileage normally works if it's a older vehicle, it's been, paid off, but you still have to own it, and you have low operating costs. In that case, you would actually come out a little bit ahead under the standard mileage method. The actual expense method works better if you buy a new car or a late model car, um, usually some higher dollar amounts. And again, the key, the numerator and the denominator would be, again, the business miles versus the total miles. Now, to use the actual expense method, in order to get the full advantage of using this method, is your vehicle needs to be used for greater than 50%. So in order to claim the actual expense method. So assuming the same type of, let's say you drive it 80% for business use, and so that's greater than 50%. And so it would help you to use the actual expense method, assuming all other facts and circumstances lie where they may. So under the actual expense method, you're going to get your gas, repairs, insurance, lease payments, or this thing called depreciation. So depreciation is a is an amount that's regulated by IRS tax tables to match the cost of the asset, in this case, a vehicle, um, with the passage of time. So as a car gets older, it's worth less and less. So that decrease in value, you can write that off under a concept called depreciation. I'm sure you guys have heard that before. Um, so you get to take that under the actual expense method, but you don't get to take that under the standard mileage method. With cars being, more and more higher and higher costs every year. So if you do buy a newer model car or a new car, the actual expense method is the one that would be more favorable. Again, in addition to those expenses, you get tires, registration fees, oil changes, car washes, tolls. I think tolls and car washes would also be applicable in the standard mileage. So those two things would stay constant. Again, the key thing here is to keep track of your mileage. Um, Again, you can use an app for that, or you can just maintain it manually. That's what the IRS looks at. And if there is an audit, the the vehicle expenses, along with a couple of other expenses we'll get to, are usually the 3 or 4 items that they look at most. So good record keeping is key to maximizing your expenses.
Roger, we have a question. It goes back to the independent contractor
Yeah.
section. So the question is, are we protected as independent contractors when working for dental clinics?
Okay, so the question really protected against what, liability, or maybe, so the way I'll answer that is I'm assuming it's a it's a risk assessment type of issue. If you are an independent contractor, you may have to um, you may have to buy your own professional liability insurance. That would be a true statement, you know, unless the overreaching clinic is managing that, or if they're supplying that. I think, but if you're an independent contractor, you're kind of assumed to be in business for yourself. So you would have to really be responsible um, to get your own professional liability insurance. In my profession, it's called E&O insurance, and I get it through my national agency. Those are usually the best places to start out with. So hope that answered the question. Okay, do's and don'ts of going solo. Um, again, we're just gonna briefly touch on these topics. We could have the entire presentation on each one of these, especially on choice of entity. So the simplest thing is, hey, you're solo, you're just starting out, and you're just a a one-person show, and you could be something called a sole proprietor, Schedule C, which basically means profit or loss from a business. Now, if you want to add a little bit more liability protection, then you would go a corporation route, which means you would register with the Secretary of State, get a corporate charter, get something called an EIN number, which is a employee identification number. So basically, you're trying to create some separation between you as a person and the business as an entity. So in case your insurance, you may not have insurance, but assuming you do have insurance, every insurance has limits. Basically, what you're trying to do is creating some type of separation between you as an individual and the business assets and liabilities. In order to do that, something called commingling of funds is something that is frequently um, a point of contention. So you have to separate your business and personal finances. That is key because if the taxes may be the same whether you're a sole proprietor or, for example, an S corp, but the key is in order to get that limited liability protection, um, you cannot commingle funds between accounts or even between credit cards. We've seen these types of situations time and time again where where a taxpayer would use a personal credit card to pay business expenses. Now, if that's an isolated instance, that is fine. One time, maybe 2 times. But in case of an audit, saying I did not know is not going to work. Um, so so what you have to do, again, preserving that corporate veil, like different buckets. So the burden of proof of deducting a business expenses charged on your personal credit card is really on you. And so it's up to you to convince the auditor that was really a business and not a personal expense. Whereas if you have a business credit card, whether it be, Amex, Visa, MasterCard, really doesn't matter, and you kind of confine your business expenses to business credit cards and you're able to deduct those, again, you're preserving that line in the sand and preserving the limited liability uh, structure of your corporation. Um, that is the cause probably of about 75% where there has been commingling of assets, basically. And so whether you're a doctor or a dentist or an accountant, it doesn't really matter because the concept is called piercing the corporate veil. So we can't give enough importance to that concept. Obviously, other things like buying a vehicle, building, real estate, you may want to buy the building that you want to practice in. Again, you would create a separate LLC, limited liability company, implying in its name in order to limit your exposure and risk while practicing your profession. Um, the other point I wanted to add is yes, you can do these online, deciding on your choice of entity. And but we normally, even though we're not attorneys, we do recommend that you use an attorney, especially in a partnership, have an operating agreement. Even if you open up an S corp, have that corporate charter, have an operating agreement, because those are really the rules of the road uh, that create structure and that create that separation, that it's separate from you, so it doesn't impact your personal assets.
Roger, we've got some questions.
Yeah,
So there's two questions that are related to mileage deduction. So if you want, we could maybe answer those for the wrap up, but we've got two questions that are related to what you're talking about right now. So the first one is specifically in regards to what you're speaking about now, business
yeah, go ahead.
expenses and commingling.
Mhm.
Does that also apply if I am a sole proprietor with a 1099? So that's one question. And the other question related to this section is, are we considered or have to apply as self-employed if we are in a partnership dental business? What are the pros and cons of partnership business in terms of tax returns?
Okay, I think I will try to answer the first one,
Okay, and I'm
and I
happy to
will.
repeat it if you want me to repeat
Yeah,
the.
if you can repeat that, and I think on the second one, I'll try to touch on some aspects of it, but that's a deeper dive in the partnership.
Okay. So, with regards to the commingling of business expenses, does that also apply if I am a sole proprietor with a 1099?
Okay, so that's a great question. So if you're getting the 1099 under your individual social security number, which a lot of you may, okay, there's nothing wrong with that. Um, you are still you still get all the deductions as we talked about. It's just that there's no legal difference between you operating as a dentist versus you just doing your personal taxes because it's the Schedule C, which which we fill out for all our 1099 sole proprietors is all in the same, it's a subset of the personal taxes. So so in that case, basically your personal assets are at stake with your business because there's no limited liability. Okay. So if you do want to have that protection of liability, then you would create an LLC, S corp, or a partnership. You would register with the Secretary of State in whichever state that you do business in, and then you would get an EIN, which is basically like a social security number for that business, and then you would file separate returns, and that would give you limited liability. So maybe, as an add-on, I would say if you don't know which, whether the sole proprietor avenue is for you or not, um, you may want to try that for a year, you know. And if the record keeping and those sort of things and the quarterly taxes, if that's a lot, then you may want to go back to a W-2 scenario. But if you really like it and you think, hey, I like all the deductions I'm getting, I like a little bit more freedom, the flexibility of hours, then you may want to use that sole proprietor thing as a temporary measure, because as you start getting more and more patients, the liability increases, of course. Then at that time, maybe in your second year or whatever time frame is ready, then you may want to add some more structure where it would be a separate tax return. And that's what will give you the benefit. Again, maybe not from a tax point of view, but definitely from a liability point of view. So I think that should kind of clarify where we are with, a 1099 versus having that same 1099 income under a quote unquote business structure or a business entity. Chris, can you repeat the second question again?
Yes, the second question is, are we considered or have to apply as self-employed if we are in a partnership dental business? What are the pros and cons of partnership business in terms of tax returns?
Okay, so if you're in a partnership, you would have to, and I tell all my partnership clients, have an operating agreement between you and the other partner. Most of the partnerships, they start out as friends, and my advice to all my partnership clients is whether if the business works or not, you want to walk away as friends also. So it's kind of establishing the guardrails, the rules of the road. Um, Things are great once people are making money. Things are not so great when the business is in a loss, and then the roles and responsibilities really become highlighted. So first and foremost, I would recommend a partnership agreement between the two partners or three partners or a group of partners. Um, and that would be the most uh, important document. Partnership then would register, as a partnership with the Secretary of State, and and then they would set up something, the quarterly taxes. So the way partners get paid is they do not get a W-2, they get something called a K-1, which is their share of profits and losses from the partnership. Now, how they get paid two ways. They get paid with something called guaranteed payments. And so that could be monthly, that could be every 2 weeks, but that is very similar to a person getting a W-2. The only difference is a partnership would pay taxes, or the partner would pay taxes on the guaranteed payments every quarter. So it's very much similar to how you would work under being self-employed, and that's how you would pay for your guaranteed payments. And that would be on a quarterly basis to the IRS. And that, again, would include the federal, the state, the Social Security, Medicare, and you would pay that on a quarterly basis. Now, in addition to that, if the partnership still has a profit at the end of the year, so let's say they pay the partners, the employees would still get a W-2, the partners get these guaranteed payments like they're self-employed, and they pay quarterly taxes just like a self-employment person would do. But in addition to that, they would, the business, if it makes money, then those taxes would be paid quarterly as well. Now, because the accounting may not be done till the end of the year, those taxes on the profit and loss of the business then would be paid according to, um, again, the dates that those quarterly taxes would be due. So the dates for those quarterly taxes are basically April 15th, June 15th, September 15th, and then January 15th of the following year. So it is a little bit complicated following these regimes, but then you're really getting two streams of income in a partnership. One would be your normal guaranteed payment, and then one would be the profits of the business. And so you really, I mean, if it's very profitable, it allows you to kind of live one or two or three tax brackets above what you would be doing as a W-2 employee because you're deducting a lot of business expenses, but it does demand good record keeping, good payroll systems, and then all the compliance terms that we just mentioned. So great questions. And so, I think if you, I mean, I'm a sole proprietor right now. I have a lot of associates, but I'm just coming from another industry conference and they discussed partnerships a little bit. And they actually even recommended that that the partners or the owners or even the associates take a almost like a personality test. And so you want to put the right people in the right positions of the business, especially if it's a partnership, and it's more than one owner or you have multiple employees or associates, and that you want to use their strengths at where those roles and responsibilities are defined. And I'm actually going to do that with my own firm. And just want to make sure that the right people are in the right positions. And yeah, great questions. If you decide to go, whether it's a Schedule C solo or an S corp or a partnership, again, planning, budgeting, and just forecasting, 6 months in advance or a year in advance is key to whether, um, basically to prevent surprises and at least have that roadmap of what those roles and responsibilities, even from a dollar point, look like. So, um, so these are just some of the points we wanted to bring up. The other point I wanted to bring up is if you are self-employed and you fall behind in paying state taxes, your professional license is actually linked to your state taxes. So, so it is very, very important that you stay on top of your state taxes. Otherwise, they may talk to the state and revoke your license to practice, or at least get a threatening letter. So very, very important to stay on top of state taxes as well. All right, so we're gonna, at this point, if there's no more questions regarding the self-employment, I'm gonna switch directions just to talk a couple of minutes about student loans. All right. Student loans, nobody wants to deal with them, but they did help you graduate and become a professional. And so there are lots of student loans. the deferment period varies, the deductibility of student loans um, for the deductibility depends on your income level. The different topics we're going to cover is if there's going to be any forgiveness, interest. That's kind of like the main point. What you can deduct, how much you can deduct, and those type of topics. All right. Um, one of the major things here is that student loan interest is a personal expense, not a business expense. So even though you may open up a business, your student loan is still a personal expense. So the definition according to the IRS is it'll give you business deductions and common expenses, common and reasonable expenses in your profession. But if it qualifies you, if you had to incur some expenses to qualify you for a new profession or a profession, then those expenses would not be deductible. So that's the main reason that the student loan expense would not be deductible with the interest. And so right now, the maximum you can deduct is $2,500 of student loan interest. And again, the timing of that is what a lot of dentists that are our clients want to play around with. So that's where the decision of whether you want to file jointly or you file married separately. So that really depends if your spouse is working, whether he or she's a student. And so it gets complicated pretty quickly. Um, the student loan the student loan interest deduction is also capped, and so usually dentists get that for the first couple of years, but once their income goes above the thresholds, then even that interest is not deductible. But the main reason um, the tax planning around that is really how much do they want to, the time period that they want to defer till the repayment period sets in. So there's so many different plans. Those are all income-driven repayment plans, and they could be anywhere from 0, 6 months, a year, 3 years. Um, and without getting into the nitty-gritty, um, it's kind of like a case-by-case situation, looking at the loan documents and kind of projecting if people are going to get married, when they're going to get married, what that income stream looks like, and then deciding whether we should do married filing separately or we should do married filing jointly. And so whenever we get newlyweds and one of them is a dentist, we kind of do the taxes both as married filing jointly and as separately, because if they still fall under certain dollar thresholds, depending on the plan, that could help them save for other things like buying a house and things like that. So, um, okay.
Roger, we just got a minute left. We did have two questions still in the queued up for the Q&A, so I just wanted to make sure that we got to those and then we can wrap up. The first one is, I thought vehicles could not be deducted for commuting to and from home to a regular place of business, even as an independent contractor. Is that not considered a personal commuting expense by the IRS? And then another question with regards to mileage deduction is, would it be accurate to say that dentists can really only benefit from mileage deduction if they have two offices, as commuting from home would not count?
Okay, so if one uses, let's say you're living at home, you, and your home is kind of like your home office. And so if you use that to go to dental practice 1 or dental practice 2, you're using basically your home and your office is basically the same address. So in that case, you would be able to deduct it. If you have an office, like I have an office, but my home is 5 minutes away. So they are right in that scenario that my commute from my home is not deductible. But then when I go from my office to any of my clients or any conferences that I go to, that would be completely deductible. A place of business that is separate from your home, and that's your business. Absolutely right in like how I deduct my vehicle expenses. But if let's say I just had a home office that I didn't have a brick and mortar and I'm just working out of my home. So in that case, that scenario would not apply. So anything from my home to a client visit, to a conference, that would be deductible because I have no commuting uh, distance in that scenario. So, and what was the second question, Chris?
Sure. The second question was also about mileage deductions, and it was, would it be accurate to say, so the first one was, can vehicles not be deducted for commuting to and from home to a regular place of business as an independent contractor? Is that not considered a personal commuting expense by IRS? And then the second question was, is it accurate to say dentists can really only benefit from mileage deduction if they have two offices, as commuting from home would not count?
Yeah, so I think we kind of covered the scenario. Hey, if you're working out of your home, I think you're good. If you have an office, whether you rent it, lease it, or you own it, that commute from your home to your office, that commute would not be deductible. So I think it's kind of like the same question, but I hope that clarifies. Um, so that's all I had. We can entertain more questions. We will be there at the booth. I believe our booth number is 219, and and you can ask us questions there. Also, when we have a QR code here, so when they scan it, um, have this winter. So